Mis dos hijos le mandan saludos. Dicen, ¿cómo? Me dice, ¿en serio? Él coach el
I did coach at T-Rats for a long time. Pero ¿quién es tu hijo?
A ver, ¿quién pregunta más?
You know it's not.
I know those. Where do they go now? Do they go to Gulliver? But Abel is like a senior or something now, right? Yeah. Abel no era amigo de Benji. Y de David Morales y de Slushy.
Pero ya no.
I'm so jealous. Mad at myself.
I just let it ride.
Marco Bruno.
Marco vive al lado mío, like literally like right next to me.
I actually never picked up horse.
¿Y él está remando ahora o no?
Wrong with me.
Tu hijo no, porque Marco rema, that's all he does.
No, mi hijo juega golf.
Because a lot of times
Juega golf.
when people speaking Spanish around typical Americans, we just block it out. Instead, we should be proactive and trying to get it.
I'm half Korean.
Yeah.
I'll still very much Korean. I've been in Iraq for 2.5 years. And I don't speak Arabic.
Y se ha dedicado a golf.
Mejoró ya está perfecto, pero
And I took
Close them out, man.
I don't remember any German. So now I'm in Southport. I said,
Y es que queda
time in your
bien.
life that you can learn that.
So he's like a junior.
Gotta be
Now you don't talk to
In
me.
Gulliver.
Yeah, here a lot of times they want you to really, they really want you to pick up the Spanish language.
Para poder jugar fútbol. We'll talk. Está complicado el tema. Porque el colegio está repleto.
No, ya me llamaron y me dijeron, ella es a Fort Point.
Y te dijeron que sí o que no.
Que a la hora que
Listen, we lost a lot of kids.
Bring a Spanish translator.
Okay, that's fine.
porque
Okay.
es muy bueno, es muy bueno.
So they'll take it.
Y es muy bueno deportista.
Good, we'll take
What
it.
about Mary? I want another smoke.
Well, we'll talk. We'll talk. Okay.
Okay.
It's easier
That's
for
an
you.
investment.
Just, do you live in Key Biscayne, no? It's easier. Okay, class. Welcome back. I hope you had a nice lunch. Did you have a nice lunch?
Ready to take a nap now.
Dude, who's making, I used to, when I was in graphic arts, I worked at 3 different companies over like a 10-year period. They were all sort of like in the industrial part of Miami, Hialeah, Opelika, that area. And in each one of the plants, always had a lady that would come around like 1:30 with like a big Pyrex full of, Cuban coffee. And it was like, she was productivity, she got everybody going. So, do we have anybody make coffee now?
We got Red Bull.
Hey, I sent a couple of different lists out as part of the first. I put my eyes on. I can't see without my eyes anymore. So to be honest with you, it was so long ago, I don't even remember where I got these things from. I think I got them from the Maria Davis book. But the reason that I like this list is, welcome. You can just sit wherever. So the reason I sent this list out was, in one way or another, we're going to mention all these little acronyms and all these different terms, either in this class or in the program. And there will be some exceptions, just because business practices have changed. But for the most part, you need to be familiar with these terms, okay? Now, I'm not going to go through all of these. The list of abbreviations, that's why, in a graduate program, for those, there's a lot of self-learning involved here. Self-learning involves, taking time on your own, quiet, right? No television, no video games, read, and it helps to read if you take the plastic off the book, too. If you were going to do that, you should have sat in the last row. Okay, he gets no preparation points this time. It's like, okay, I know.
I was hoping you were going to tell me a cheaper way to find this book.
There is not.
So you can return it, right, and get your money back?
It's got 2 books, one's for show and one's for go.
And the other one's for tell, right? Okay. So listen, just a couple of so the list of abbreviations. There's a whole bunch of these. The first 4 or 5 talk about different bodies that have existed over time or continue to exist. The AICPA is our professional guild, right? So it's our professional association. We're not unionized, but we do have an organization that represents us. We have state societies, so in Florida there's the Florida Institute of CPAs, and there's the American Institute of CPAs. At one point in time, the AICPA actually had organizations within it, or bodies within it, that would promulgate accounting knowledge, or GAAP. In particular, one of the ones you see below, the Accounting Principles Board, was a subset of the AICPA at one point, but none of these organizations are involved in promulgating accounting information. Now that's all done by the FASB, the one I mentioned earlier, right? The Financial Accounting Standards Board. And what they promulgated were FASs, or what I call FASs, Statements on Financial Accounting Standards. On the first page, IRS, Internal Revenue Service, you'll hear me say that. IRC is the Internal Revenue Code, right? There's some different entities that you should be familiar with, LLCs, limited liability companies. You see those in real estate. You don't really see MLPs anymore, master limited partnerships. Those, you see that more in like energy syndications. You don't really see that in real estate. But back in the 80s, a lot of the capital that was raised in the industry was done through MLPs. REE, I mentioned, that is sort of the trade group for REITs. So it's a lobby, it's a, industry association that provides and supports the real estate investments trusts and their investors. PP&E I use a lot. PP&E, plant, property, and equipment, right? So I use that a lot. PV, present value. REIT, we'll talk about REITs later today. The SEC. So the AICPA, talk about different bodies. I'll talk about some of these. So the AICPA is a professional organization, right? A society of accountants. The SEC is a government body, right? Which provides guidance and enforcement. We talk about it in the capital markets class for publicly traded companies or instruments, okay? And so the SEC provides guidance and also has regulatory authority over publicly traded companies or instruments of companies that trade publicly. Okay, a couple of ones that are important that you will hear at one point in this class are the 2 on the bottom of the first page, SPE and SPV. SPV. You hear this all the time, okay? Special purpose vehicle. What's a special purpose vehicle?
Vehicle that has a special purpose.
Yeah, oh, very good. He speaks English. Okay, all right. Can we go a little bit beyond? Okay. Typically, when we talk about an SPV, is we talk about an entity that is created in conjunction with a particular transaction. In the context of real estate, when we talk about SPVs, we talk about entities that are created solely for the purpose of typically holding an asset, okay? And so I'll go through later on, it's not in the textbook anywhere, but I'll go through how real estate companies are typically structured, at least in this country, and part of the attempt to try to isolate risk is to create a special purpose entity, a special purpose vehicle, or a series of entities that hold an asset, hold the ownership to a particular asset. A VIE we'll talk more specifically about in the 5th class. It's a variable interest entity, and that's variable interest entity. And this is an the actual defined term in FIN 46, okay? And FIN 46 is a reaction, we'll get into more detail, this is a reaction to Enron. Does anybody remember Enron and the blow up with Enron? So the accounting world's reaction to Enron and what caused, or part of what caused the blow up of Enron is FIN 46, okay? And FIN 46 defines what's called a variable interest entity. I'm not going to get into the details of that today. We'll do that in the last class. The glossary has all kinds of information, all kinds of terms and definitions that you need to know, okay? I mean, the second one there is AFFO, but before we get to AFFO, we need to talk about FFO. Does anybody know what FFO stands for?
Funds from operations.
Okay, can somebody define what funds from operations are? So it equals funds from operation. Okay, so in the context of most businesses, profit is defined in terms of net income, right? Net income. But in the real estate industry, we don't like to talk about net income. Why? Because we perceive in this industry that cash flow is more important than net income. Net income typically, so if you look at a typical P&L, right, you got sales, you subtract cost of goods sold from sales. Again, it's a very generic P&L, okay? Very generic P&L. That gives you something what's typically called gross margin. From that, we typically subtract sales, general, and administrative expenses, okay? SG&A, okay? Okay, and from that we'll get earnings before income and earnings,
EBITDA.
interest and taxes, okay? I didn't say EBITDA. Who said EBITDA?
I don't know who's
Saunders, did you say EBITDA? I said EBIT, okay? Now, not all companies, in fact, most companies will incorporate depreciation, okay? Depreciation directly in either cost of goods sold or in the SG&A, okay? So in the context of accounting presentations, we typically do not disclose depreciation below any particular line. Depreciation is a line item within any one of these, items, okay? So we don't typically talk about EBITDA in accounting terms, okay? That's more of a finance term, okay? But good point. Earning before interest and taxes, okay? Now, ultimately, and then you get interest, right? Interest, and then you get EBT, and then you get taxes, right? And then you get net income, right? That's sort of, very top level how an income statement typically looks. But embedded in all of this is this depreciation number, right? Depreciation, what is depreciation? What's depreciation? Does anybody know what depreciation is? Stuff gets old, okay, but okay, give me more.
Decrease in value over.
So yeah, so it's an accounting concept, okay? So in accounting terms, we like to perceive that assets, items that are acquired, right, have some sort of devaluation or loss. It could be because of use, passage of time, wear and tear, etc. So there's an assumption that assets don't last forever. And so somewhere along the way, somebody came up with this concept called depreciation, right? And so what depreciation attempts to do is to account for that wear and tear, that use, that passage of time, that devaluation of an asset under some sort of systematic mechanism. Okay, there are a lot of different, I'm not going to get into them unless you have questions about them. There are a lot of different methods to come up with what the depreciation charge should be. There are some for book purposes, there are others for tax purposes, right? So there are a lot of different ways to calculate depreciation, but it is a systematic way of accounting for that. But it is a non-cash expense. And so what people like to look at, when you look at net income, it's got this depreciation which doesn't consume cash. So in the real estate industry, because it is an asset-heavy industry, right, there are huge depreciation numbers. We also know that real estate, because it conforms to different, I don't want to mix things from other classes into this, because it conforms to other factors, interest rates, rents that increase, yields, cap rates, don't lose value in the same way that other assets lose value because of wear and tear. And so we kind of say, hey, we don't really want to worry about depreciation that much. We really want to look at cash flow, okay? So somewhere along the way, somebody came up with a concept of, in a REIT realm, FFO. In most real estate companies, we talk about NOI, okay? And NOI is a measure of cash flow. FFO is a measure of cash flow. In the real estate realm, it's a proxy for net income. So instead of using net income, we talk about NOI in privately traded companies or privately held companies. We talk about FFO in publicly traded companies. And essentially FFO is net income plus, we add back depreciation, okay? Plus or minus, and most people don't look at this, okay, any gains or losses, okay, on sales of assets. Why? Because they're not recurring. So we're kind of looking at this and saying, hey, this is the recurring cash flow that this business is producing. So that's the first level we call FFO. Well, some people say, hey, but more than FFO, there's AFFO. So, Robert, what's AFFO? Oh, that's adjusted FFO. Okay, so how do you adjust FFO? How do you adjust FFO?
Take out the gains for the one-time.
Well, it's not, so we've already, no, so you start with, so AFFO, adjusted funds from operations, right, equals FFO plus, yes, Daryl?
It says plus or minus gains from sales?
From sales of assets. Yeah. So we start with FFO, and we add, we add back CapEx, any capital expenditures that we've made, we add back CapEx, and we add or subtract the impact of straight line rents. And you can say, what are straight line rents? Stay tuned for the second class, and we'll talk about what straight line rents are. Okay, because that's another accounting impact of how we treat leases in the commercial real estate realm. So you guys didn't know that there were accounting implications to the financial statements that you look at, but you're now starting to see that there are things that we do that the accounting gods mandate us to do that have an impact on the way we reflect financial statements. And certain professionals in the industry have said, hey, we need to adjust the way that the accountants look at the financial statements so that we can look at them in a different way. And again, people are looking for cash flow, okay? Cash flow. So this is a proxy for net income. We call it NOI in the private company realm. We talk about FFO in the REE realm, okay, in the REE world. AFFO, I recently saw, and you will see in the case study that we'll do for the third week, that people are now coming up with something called core AFFO. And for the life of me, I couldn't find what that was. But ultimately, it's kind of like, if you guys look, who follows the markets? Is anybody like, you follow the markets? A little bit. You a little bit?
I attempt to.
You attempt to. We had a guy in the last, they just graduated, that was like into buying bitcoins and all that stuff. I mean, he was like, all his questions were about the market. But if you follow the market, every quarter when companies report gains or report income, have you noticed that they all report X items? What are X items? What does that mean?
One-time expenses.
Right, but if every quarter you have one-time expenses, they're not really every quarter, right? So I'm not going to get into, the accounting tricks there, but basically it's companies trying to say, hey, our real recurring income is this, okay? Even though the next quarter there's more one-time items again. This is the same sort of concept of saying, hey, let's strip out the stuff. Here's what our consistent cash flow is. It is the cash flow that this business is throwing, okay? And that's how you should really be able to evaluate us. And I'm sure that this is somebody's additional iteration or invention of, well, you should really measure our particular operations this way, or our cash flow, or our performance this way, okay? So,
quick question.
Yes, sir. Yes, question, ask.
Oh no, I was trying to figure out what was going on back there. Is the real reason they go through all these measures to find different ways to evaluate a company's success? Why do they do that?
I'll answer that question. Did you guys catch the question is, why do people use a different measure rather than net income? That's ultimately, again, what I'm trying to say is when companies say, hey, my earnings were $1.50 a share, but we had these special one-time items, so we really made $1.80 a share, right? People say, go look at my net income, look at my FFO, as a company saying, hey, that is a truer measure of what my health is. And you should look at my trends in FFO or FFO per share. And you should see my trends in FFO per share compared to peers. And you should see my, trends in FFO in comparison to prior years, okay? And so again, and as it relates to relative valuation as well, what multiple of my FFO is my share trading at, okay? So ultimately, this is an attempt by the publicly traded real estate companies to say, this is a better gauge or measure of how we're doing than net income. I'm not telling you it's right or wrong, I'm just telling you what it is, okay? Yes, Dustin?
Because a REIT will inherently always have a gain or a loss from a sale within their potentially quarterly metrics if they're in
Well,
and
I
out
mean,
of real
REITs
estate,
tend to be active.
whereas like Amazon.com, it wouldn't, because they're not necessarily, buying and selling assets. I mean, I guess their inventory, I don't know. Maybe Amazon's a poor example, but just like my contracting company, we're not buying and selling things.
Yeah, but that's not really, that's not really, the reason that, listen, the difference is that when a REIT trades an asset, it is selling a fixed asset. It's not selling inventory, okay? And so what happens is when you're selling an asset, it has a significant value. It may have a significant gain or loss associated with it, as opposed to an ongoing retail business, for example, which is trading on its inventory all the time, which isn't going to have, that sort of, in fact, you're trying to see what the profit is on that turnover, on that sale of inventory, okay? But the real reason that you want the FFO is not to exclude the gains, because again, a business in the long run, as much as it has transactions, a REIT can't be that significantly dependent on acquisitions or sales, okay? Ultimately, REITs have to exist because of the cash flow that they're distributing to shareholders. Okay, that's why REITs exist. But the real reason that FFO is there is to see what the measure of cash flow is. And why is that important? So let me just jump. I was going to talk about REITs earlier on. You cover REITs, I think, in the finance class or in the investment class. I don't cover them much, but under section 865 or 856? Okay, one of the two. Under section 856 or 865, don't quote me, one of those two, of the Internal Revenue Code, okay, there is an entity that is viewed as, or determined or created, which is called a real estate investment trust, okay? So real estate investment trusts, this goes back to 1960, it was an attempt to create a tax-efficient mechanism for individuals to own real estate. So it goes back to 1960, okay? Now, there's been a sort of interesting history with REITs because, so in 1960, the Internal Revenue Code, creates this entity, right? And ultimately, here's what the bottom line is. An entity is a REIT, right? If it, or can be construed or taxed as a REIT if it generates essentially passive income. Passive income. What's passive income as it relates to real estate? Rents, and what else? By choice, there are two kinds of REITs. What's the other type of REIT? Interest. Interest is passive income. Interest. So, essentially, if the bulk of your income is passive, there's very complex rules on all this, okay? So, if the preponderance of your income is passive, and you distribute 90% of your net income to shareholders on an annual basis, okay, you can elect to be treated as a REIT. What's the benefit of being treated as a REIT? It's a disregarded entity. It's a pass-through entity. It doesn't pay tax. There's no double taxation. So the entity itself doesn't pay tax. The individuals pay tax on the dividend that they receive. And so, why have I given all this description to you? Because people care about the cash flow that the REIT has. Now, there's there's sort of a problem in distributing such a large or significant component of your net income. And that is, you got no liquidity. So probably the only industry in the marketplace that is allowed to go into the capital markets on a recurring basis and essentially dilute itself, issue shares, are REITs. Why? Because they need capital all the time. Why? Because they're distributing, they're never retaining any of their capital, they're distributing all the capital. Big multinationals probably hold on, you know, if you're like Procter & Gamble or Kraft or Exxon, you probably only distribute 30–40% of your income. So if they were distributing 90% of their income, they couldn't do any capital expenditures, right? And because REITs, because real estate is a capital intensive industry, right, it needs capital, but if you're distributing all of this, right, REITs need to go back to the capital markets continually, okay? But again, why is it important? How much cash flow is it generating as a business, okay? That's why people are concerned with FFO. Let's just finish on REITs. So there's a whole bunch of rules in here. We'll talk a little bit more about them, I think, the last class. TRS. REITs can have what are called taxable REIT subsidiaries that can, say, for instance, develop. Development is not a passive activity because development doesn't generate rents in and of itself. So REITs are not development companies. But as long as, you know, again, I forget all the rules on this stuff, have less than 10% of your assets and 10% of your income and 10% of your personnel is dedicated to this taxable REIT subsidiary, then it stays at, you don't invalidate your REIT election, but that little subsidiary pays tax, okay? So, but again, it is a mechanism, it was a mechanism that was created for the purpose of allowing people to participate in the real estate capital markets. Now, there are two types of REITs, broadly. There are property REITs and there are mortgage REITs, right? So which are the two different sort of assets that can generate the passive income, all right? There are hybrids. Vornado's one that sort of plays all over the place. Some of the big office REITs, Boston Properties, Matt Calley have been doing a little bit of sort of financial, you know, providing mezz debt and things like that. But REITs tend to focus on one side of the fence or the other. About 200 of them out there, publicly traded. There are a bunch of private ones. We'll spend more time in the capital markets going over that. In fact, one of the articles that one of you can research is whether specialization in a REE actually matters. Did you do that one by any chance? Was that one yours?
Yeah.
Okay. Does it matter?
I don't think you liked my project.
I didn't say I didn't like your project.
No, I don't. I remember that the findings were really hard to decide and decipher whether specialization mattered because historically they were very similar.
So what you typically see is, whether it really matters or not, typically REITs tend to focus on a particular asset class. So REITs tend to be focused on retail or hospitality or office or industrial.
So how is hospitality REIT, how is that a passive? Did they split that business?
Because it goes back to what Danny was mentioning before. They are not operating a real estate business. They're not operating a business. They own a real estate and they lease that business. They're getting rents, right? So
it's complicated, but you do a leasing company.
Right, no, I get
That
it.
is a lessor company. And some of the cash flow comes from leasing, so you guarantee leasing, and then you distribute the rest of what you share with the operator as a profit. But there is a secure rent, so to speak. There's no leasing contract, but there's a rent.
So, yes, Maricel.
Can you go back a little bit on funds from operations? So it's going to be the net operating income plus the
Depreciation. Plus or minus gains or losses on asset sales.
And to adjust to this plus or minus a straight line.
Straight line rents and capital expenditures. What are traditional capital expenditures in the real estate business? We'll go into these in more detail, but
Air conditioner?
well, in broader terms, yes. So we talk about tenant, we talk about like tenant improvements, right? We talk about tenant improvements, right? We talk about building improvements. Okay. Where was I?
I was over here.
So wait, Ed, this might be, can I ask another question?
Okay.
I'm thinking about our meeting earlier today with Styles. So they act as a developer, the contractor, but then also as the investor. So so on the investment, even though it's one project, their capital gains from what they make on the investment side would be a passive income. And
That's a
then
stupid question. No, I'm just kidding.
they're breaking it all
Well,
apart.
No, okay,
And
listen.
they're-
Okay, listen, why don't you hold on to that question? I'm going to go through, well, just sit wherever. You're auditing the class? Yeah, just sit wherever, as long as you'd like. Why don't you hold on, hopefully around 4:30 or something like that. I'm going to walk through a typical real estate operating company structure. And once you lay that out, why don't you re-ask me that question at that point, okay? So I sort of jumped. So that was just a general, sort of very broad stroke on REITs. You'll see more about them, you'll learn a little bit more about them, but it's a tax advantage mechanism that was used to allow widespread individual ownership of real estate, okay? Because if it weren't for REITs, it'd be very difficult for us to own office buildings and retail centers and all that on an individual basis, right? Now, to your question, back to 1960, yeah, so the REITs went through a sort of, rapid growth, and in particular in the 60s, they were very popular in South Florida. South Florida in particular had mortgage REITs, and I was just a little kid, so I don't know what the nature of the problem was, but there were a lot of shenanigans, and REITs essentially disappeared in the mid-1970s. Most of the REITs went bankrupt, and they had really a very bad reputation. And it's only in the sort of early 90s that they've kind of gathered steam again. And, by the late 1990s, early 2000s, they started being included in major indices, the Wilshire, the S&P, and are now really, sort of mainstream investment vehicles. And in the capital markets class, we'll talk about what the implications of that are, because there are definite implications to private ownership of real estate and public, because especially the inclusion in indices now has different implications. Okay, but you can hold on to that question. But look, this is like a wealth of stuff, air rights, and I'm like, I can't go through all of these things, but if you have any questions on any of these questions, like ADC, you're going to see an ADC in one of the case studies, an acquisition, development, and construction loan. Okay, CAM, what's CAM? CAM?
Common area maintenance. Common area maintenance.
Okay, what is common area maintenance?
What the tenants pay.
What the tenants pay. Okay, but what?
Taking care of landscaping.
Yeah.
Okay, but so it could be a couple of different concepts, right? So it could be we could have a building with several suites, right? And one common area inside it, right? And all the people, have bathrooms and whatever, elevators and all that. And so all the individual tenants here pay a proportional share of that item, right? But it could also be sort of a bigger sort of concept, right? Where we've got a parcel of land and we've got 4 buildings, right? And now we got to take care of roads and maintain, green, landscape and all that kind of stuff. And everyone is paying, again, their proportional share of those items, right? Yep. Okay. So a lot of these items, cost recovery method, costs, we'll talk about that in the context of each one of the different items that we go over in weeks 2, 3, 4, and 5 of this class. Okay, so I'm not going to sort of go through that. Debt service is important. You'll see that in a couple of case studies from now. We'll take a look at debt service or fixed charge, another way of saying it, coverage ratio. So how much cash flow is a business generating in order to meet its debt service. encumbrances, we're gonna use all these words, easements, funds from operations, I mean, so I'm not gonna, lease, what's a lease? What's a lease? I like lease, lease is important, that's a big word, what's a lease?
An agreement to use space.
Between the landlord and the tenant.
Okay, pero, I mean, let's put it in the context, more broader context, right? So it's a right to use. It's a right to use, and in particular, in the context of this program, it is a right to use land, a building, or a portion thereof, right? For a
Particular time.
specific period of time, okay? So it is a right to use a particular asset, right? A real estate asset. And what's real estate? What's real estate?
Any tangible assets.
Any tangible assets. Okay, let's try door number 2. You'll hear that one a lot.
Real estate is real property.
Okay, so in every class, I'm going to define, I think the jokes are getting old, right? In every class, I'm going to define real estate differently. In the context of an accounting class, I'm going to define real estate as land, buildings, and improvements thereon. That's important to know, okay? Because that's the basis of how we define real estate in this class. Land, buildings, and improvements thereon. So, the whole ball of wax, okay? So, going back to a lease is a right to use, in the context of this program, a right to use real estate for a specific period of time. Yes, it is between a landlord, the parties are a landlord and a tenant. The landlord is the owner, right? And the tenant is the one who is acquiring the rights to use, okay? So one is ceding rights, the other one is acquiring rights, okay? I'm not... Let me see if there's any other sort of... like-kind exchange. Why don't I jump over on that one? Like-kind exchange. What's a like-kind exchange? 1031.
It's when you.
Well, no. No. Okay. So in section 1031 of the Internal Revenue Code, we talk about the tax implications of a like-kind exchange. What is a like-kind exchange? Let's start, and we can talk about tax implications of it. What is a like-kind exchange?
For example, if you and I decide to exchange
My
properties
truck for your car.
to an extent, yes.
Yeah.
What has to be like? A truck for a truck?
Have 4 wheels.
It's a vehicle for a vehicle. Okay, so let's go back. I'm not going to spend a lot of time in this class talking about like-kind exchanges. I do want to talk about the tax implications of it in real estate, because it is used rather liberally, and it's really caused a big change over the last 20 or 30 years in this country. Okay, but like-kind exchange in general is when party A and party B exchange assets. Okay? That could involve cash or not. If it only involves assets, it purely is a like-kind exchange. If it involves the exchange of assets plus cash, we call that cash boot. Okay? And the accounting treatment is a little bit different, but I'm not going to get into that right now.
Would that be the tax credit?
I'm not even talking tax right now. I'm not even talking tax. I'm just talking about the business transaction. Forget the tax implications, and we'll go into that in a second, okay? But, so, I'm going to give you a real-life example. A case study, I won't use it this time. About 4 years ago, I used a REE called Avalon Bay, which is a multifamily REE, as one of the case studies. And Avalon Bay, I forget now, they were like very concentrated on the East Coast. And there's a REIT called, I'm going to say UDR, which is a multifamily REIT, which is highly concentrated in the West Coast. And what happened is Avalon Bay over time had acquired some assets on the West Coast. And UDR had acquired some assets on the East Coast. And so wait a minute, it doesn't make any sense for us, back to specialization. We're a multifamily REIT that's really focused east of the Mississippi, and we're one that's focused west of Mississippi. They did an asset swap. They swapped $300 million worth of assets. Now, what happened is they did an appraisal, and they figured out that one's portfolio was worth, I forget the numbers, but for hype, one was worth 300 million and the other one was worth 280. So they swapped it, but one party had to give the other one $20 million. Okay? And they do happen. You don't see like-kind exchanges, true like-kind exchanges like that often, but they do happen. They do happen. Okay?
What's the reasoning behind that?
That particular, from a management perspective, I mean, they thought geographically, the press release that went out at the time was they thought that geographically, they could do a better job managing assets within a geographic area. Which makes sense, right? You know, I mean, Prologis is international, okay? And so, but I can tell you, in their day, so there was Prologis and there was A&B, and they merged. A&B really acquired and kept the Prologis name. But A&B, at one point, it was headquartered in San Francisco. They had a portfolio all over the country, but they could not justify, within the size of their portfolio, having management people on the ground. At one point, they started ramping up, and it impacted their earnings, but they had to set up an office in Chicago, they set up an East Coast office in Boston, they wound up setting a Southeast regional office in Atlanta. So, all of a sudden, they went from 100 employees to 300 employees. And from a cost perspective, that's huge, right? So if you're going to manage a national platform, you just need that many more bodies. So hold on to that question, because it'll be one of the questions on this week's case study. How's that? I don't want to give you the answer away. Okay, so now, I don't want to give you the answer. I pretty much just gave you the answer, but okay. All right, so Section 1031 of the Internal Revenue Code says, Section 1031 of the Internal Revenue Code deals with the tax handling of like-kind exchanges. And in the context of the tax law today, it doesn't have to be a truck for a truck. It could be real estate for real estate. So there's a very liberal or broad context of what a like-kind exchange is. Alex, what does 1031 allow us to do?
Reinvest profits within a certain time frame.
Okay, hold on. Reinvest profits. Obviously, profit implies a sale, right? So after a sale, right, within a
certain time frame,
specific period of time.
And that's without being taxed on it.
Well, hold on. It's something you're not being taxed. You're deferring the tax. You're deferring the tax. So I buy something 11x1. I sell it 1231x7. 7 years later. Okay? I made $100,000. Right? Okay. But Section 1031, and we'll go through some of the particulars now. I get this question a lot, so that's why I want to go over it now. We'll go over it again in the last class in case you don't get it. But basically, I am allowed to defer this gain if I reinvest.
It has to be less or equal, right?
It can be more. It can be more. It can be more. Okay? If I reinvest within a specific period of time, and we'll get to what that specific period of time is in a second. Now, basically you have to go from real estate to real estate. The rules were much more, I think, restrictive 30, 40 years ago. They're pretty liberal today. Okay? And a lot of people, I mean, there's a lot of things out there. There's a lot of vehicles. A lot of these triple net leases, for example, trade now because they're easy places for people to park their money. They're relatively liquid assets that people are always trading, so they want to defer a gain. They don't want to pay. And so basically what you do is your basis in this asset carries over to the next one. Okay? That's how you defer the profit. You maintain, so if your basis in here was 50, just to use a number, the basis in the, assuming that it's for the same value, okay? Your basis carries over to the new asset, okay?
When you're referring to basis, what do you...
Your acquisition cost, your basis, what you paid for it, okay? Now, What's a specific period of time?
45 days.
No.
60 days.
I sell on January 1. So the whole period is 180 days. Okay? You've got to,
I knew it was a multiple.
we've got 45 days to identify. And we've got 135 days to close. Okay? So we got to close by 6:30, assuming we closed on June 1. I'm sorry, on January 1. Now, you need to identify. So, other parts of rules. I'm not an expert on this, but proceeds from the sale have to go to a qualified intermediary. Now, there's banks out there, there's trust companies, title companies, a bunch of people that are qualified intermediaries. But, so you got to know you want to do an exchange before you sell. Proceeds have to go to a qualified intermediary, and they sit there. You need to identify within 45 days. And what can you identify?
A number of different properties.
What number?
Unlimited, three.
Three, right?
Which was right?
Three.
The ones that amount the maximum, three.
3 specific properties, or 200% of the value you're deferring with an unlimited number of properties. Now, I don't want to get into strategy right now. We'll talk about that another day, but obviously, if you identify here, you lose all your bargaining power with the guy who's selling. So if you're buying and you're identifying on this day, you better have a contract, or better be close to a contract that day. I'll come to you in a second, Frederick. Because if this guy finds out you've identified that and you've got hot money that's going to burn off, you've lost all your leverage. Yes, Frederick?
Is that 200%?
Yes, sir.
Of what, the 100,000 profit?
Oh, yes.
So in this scenario, it'd be,
200.
you have 150, right? Because you have your 50,000 basis.
You know what? Let me come back to you. I don't remember now if it's value of the asset. I think it's got to be the sales value of the asset, not the profit that you're deferring. Otherwise, it wouldn't work. I'll come back to you on that. It should be the sales value.
So in this example, what would that number be for these?
It'd be 150, no?
So it would be 300.
It would have to be 150, right?
So it'd be 300.
Because you sold for 150, you had a basis of 50. Right, so it'd be 300 in this example.
Unlimited.
I'll
Or
confirm that next
three
class.
properties.
It should be, it's got to be sales value, not profit. Alex?
I only deal with ones that's for the accountant.
Okay.
I just find the properties, and I'm given, usually he'll tell me.
I'm looking for something in this value.
Well, yeah, we have a list of properties that are on the market that are ready to sold, so he kind of comes to us, every few months, just keeps doing it.
Okay.
But, I think it's profit, because he comes to me with like, he says I can do 2 million, but I can do 40 properties.
Yeah, but the problem is if it's, look, I'll come back with the exact answer. If it's the profit, you're not going to be able to reinvest. You're never going to get there.
Yeah.
You're never going to get in there.
Probably so.
Gentlemen, you want to add something back here?
No.
I was just
Oh.
asking a question.
Okay.
What's the
unlimited? Just confuse everyone.
So,
Unlimited properties.
so you can name 3 specific properties, 1, 2, 3, Main Street, 5, 7, 8, Broadway, and whatever. You could say, I'm going to reinvest in one of these 3 properties, or you can have however many number of properties you have that don't exceed, in this particular example, 300.
So the 3X would be at 150 though, minimum?
It doesn't matter what the value is.
But it could be less than?
It could be less than, and it's a partial deferral,
Okay.
or more than.
So you can't do partial deferral?
You can do partial, yeah. You can defer some,
Okay.
or you can buy more.
I always thought it was equal or greater.
No. You know what? Let's look. I think you can do partial. It's been a while.
I think we can do equal or some more.
And it's on the value.
The value of the property.
It's on the value for sure. It has to be the value.
Yeah, I've done many years ago, but it was on the value of the property, and it's like,
Equal or greater value.
yeah, you can add up and buy the 3, but it's
But
equal or greater.
I'm going to check because I think you can I think you could do less. I think you could partially defer. I'm pretty sure you can.
Or what, there's like a metric you would use to take out your, like your basis, like, I don't know.
Yeah, there's a proportion of the basis that you would carry over, and
Okay.
it's less. I'll confirm that. I'll confirm that. What else do we have from this?
What's the reason for the 200%? Is that to encourage larger investments, or?
It's just a way of saying, listen, you've got a limited amount of time to do it, and it's just a different way of saying it.
Can you harper more on the if you identify and the seller knows? Can you talk more about how they may kind of use that against you?
Well, so you know, I know I got to reinvest, you know, X amount of dollars by this date. Let's say that I identified 3 properties and you own one of them, and you know that I identified it. Let's say the other 2 crap out on me, and the only thing I can buy is yours, and you know that I'm under the gun because I've got a tax deferral situation. Are you going to give me the best price, or are you going to like play a little bit of hardball?
Hardball.
Who's more motivated to close the transaction now?
You are.
So
Is it common that they usually find out, or?
they have to. I mean, and I don't want to get into the whole sort of issue there later because we'll do that in the diligence class. But one of the questions sellers will ask you is, what's your source of funds? And when you say that your source of funds is a 1031, that kind of raises eyebrows for a variety of reasons. So, okay, now, in addition to Section 1031, there's a companion section in the Internal Revenue Code, Section 1033. Does anybody know what that is?
You can,
You can do partial.
yeah.
Yeah.
That's
She's not supposed to be using the.
Electronics.
You're not supposed to be using electronics.
You're
Points.
not torturing us in the next class.
Points coming.
Yeah, no, I was pretty sure you could do partial.
You're gonna torture me until.
I'm sure you could do partials. Section 1033. Okay, so Section 1033 is a similar situation, but it deals with involuntary conversions. What's another word for involuntary conversions? Condemnation. So typically in this country, and that's kind of an evolving area, and it's outside my area of expertise, but typically it is when a municipal entity condemns a piece of land that is privately owned, well, or publicly owned, because a municipality can condemn from another municipality, condemns an asset, a real estate asset, for greater use. Where do you typically see it, especially in Florida? Road construction, right? You know, who remembers all the houses that were on the side of 826 that are now part of, you know, the 5th lane or whatever, you know? So the government wants to build a road, you know, they'll either enter into a deal with you or they'll take it, they'll condemn it. And then, you know, I had a boss that used to say that the highest and greatest use of land was an involuntary conversion. Because if you get a good attorney, you can typically get a very high value. If you don't, they always start, those guys are like butchers. They work, you know, they really, you know, scrape the bottom of the barrel. But so Section 1033 deals with involuntary conversions, and you basically have the same advantage. You can reinvest and defer any gain that you've had, and you actually have a 2-year period to do it. And you know, that's just a consideration of saying, hey, the land was taken from you against your will. We're going to allow you to put yourself back in the position that you were, not have to pay tax. You know, it's kind of like, we took your land and now you got to pay tax, you know. And they're giving you a significant period of time because, again, you didn't have an opportunity to plan for this. So,
That's 2 years.
2 years,
Yeah.
2 years.
But you do still have to pay taxes, deferral.
It's always a deferral. It's always a deferral, right? Now, you know, curious. I have a. It's interesting because prevailing logic tells you. I think you're always taught never pay tax if you can avoid it. Never, seriously. I mean, that's what people will tell you. Never pay tax if you can avoid it. And I don't know. You know, I'm an accountant. I tend to be conservative. I've always had a different perspective on that. I've always been like, I don't pay it and get it done. A good friend of mine, sort of retired. He was a partner at Ernst, and then he was a publisher of the Herald for a while, and he's semi-retired. He's living up at Vero, but he owns 3 self-storage facilities. And he sold the one he had in Miami. He made a nice little profit on it. So, my question was, so are you going to reinvest? And he said, well, it was an unsolicited offer. I really, I'm going to try to identify. So I called him up a couple weeks ago. I said, what'd you finally do? He goes, I paid the tax. I just wanted to get done with it. Because it was like burning at me. And I didn't know what the pressure of the time. I'm like, I just paid it. He goes, I sleep well at night. So, anyway.
Professor,
Yes, ma'am.
would you mind to explain back again to me Wood, the 1031?
Okay, Boot is Avalon Bay has $300 million worth of assets that they're exchanging with UDR, but the value of UDR's assets is only $280 million. They're not going to exchange that, tit for tat. So what's going to have to happen is UDR is going to have to kick in $20 million, right? Or otherwise, Avalon Bay wouldn't be motivated to do the transaction, right? So this cash is what's called boot. Okay?
In 1031, if you don't want to do the 1031 and you want to liquid an asset, approximately how much is the taxes for the capital gain?
Okay, we're going to talk about taxes in the last class, and I'll give you a better answer to that, but there's no good answer because if we've been intelligent in real estate, we've probably structured transactions to be held in disregarded entities. So hopefully entities pay no tax. And so the answer is going to be, it's going to flow through to ultimately a body, and it's going to depend on his personal tax situation, okay? But, if you meet so in the context of individuals, because in the context of corporations, capital gains, preferred capital gains rates don't exist, okay? So I'll come back, I'll give you the exact hold, because they've always changed, they change. There will be, I think it was, the last time it was like 1 year, minimum 1 year, and you pay a 15% preferential rate, okay? So you don't pay ordinary tax rate, you pay the capital gain rate, and I believe it's 15%. But it was 18 at one point, it was 18 months holding period. I'm not a tax guy. So we'll deal with taxes in the last classes, and I'll prepare to give you an exact and precise answer on that. But the real answer to your question is hopefully the entity that holds the asset is not paying tax. If we've done something right in this program, we've steered you to structuring that is going to push the tax to an individual level and eliminate double taxation. I had a question back there, and then Robert had one. Did you guys have a question back there? Daryl or Frederick?
No.
I didn't have a question
I'm
either.
sorry. Okay. I'm not going to go. I keep saying I'm not going to go over any more definitions. We're going to go over a lot of these, but I encourage all of you to read these. I know you read them, because there's probably going to be like 20 questions in the test at the end of class on them. I didn't get any reactions to that. What's he talking about? Well, we're getting to page 2 of my outline for today.
All right.
That's a question.
The outline, you make that available?
My outline?
Yes.
No.
Proprietary information.
Oh, that'd be great, though. I can follow along.
First of all, it's in like gibberish.
Oh, is it?
It's in my gibberish.
All right, fair enough.
We good so far? We all right?
All right.
Everybody's good? Okay, so I promised that in this class we're not going to do accounting, but we are going to do accounting for the next hour. That's the only accounting we'll talk about in this. So, see, because it's impossible, right? Like accounting is at bare minimum an undergraduate course.
Right.
and at maximum it's a major, and es un sentimiento, it's a way of life, you know, it's a lifestyle, okay? So, you know, I can't like spend the whole term, you know, going over debits and credits. I wouldn't be doing you justice, and I don't think that you would really be getting what you should out of this class. But I am going to cover some things. Hopefully it whets your appetite. Hopefully those of you who don't know anything about it might know a little bit more. Some of you who have taken something will know a little bit, you know, will say, hey, wow, I remember that. You know, I remember that from sophomore year, you know, college or whatever. Okay, so what is accounting? And what's its purpose? Why is there accounting in the first place? Why do people dedicate their lives to be accountants, to do accounting? It's a good question.
Still ask that question.
So people, we've got people that are still, so the answer is, I'm not sure why. This one says for taxes, so.
Budgeting, the track,
Well, man,
budget.
to be able to evaluate your business.
Hey, wow.
Valuation, yeah.
Who said that? Gold star. You win the star.
Hold on, let me get the little stars in my system. There is a reason to do it. You know, it's not, there's.
All the above.
Create jobs.
There is a reason to do it, and it is not in and of itself, you know, to do your taxes, okay? Now, a consequence of having an accounting system or a structure could be that you now have the information available in order to prepare your taxes, right? So, I don't, on a personal level, do any of this stuff, but I do keep, you know, a folder, and I did my taxes last night, you know? Because I had a structure, right? So, the real reason is, why do we do it? Ultimately, it is to create a history of the financial transactions of a business. So it is the financial history of an entity or an organization. That's what accounting is. And why we need to do it is, I mean, there's a lot of reasons why we do it, but ultimately it really should start so that we know how our business is doing. So we know where we've been, where we are, and hopefully gives us a baseline as to where we're going. It can give us information to benchmark against where we've been in the past, what our expectations are, or what our peers are doing, right? So, while that could be for me as an owner of a business, it could be for me as a stakeholder. It could be as a lender, it could be as a regulator, it could be as just one of many shareholders or a partner, right? So, there are a lot of different stakeholders that are involved in the financial accounting, you know, analysis or need to have financial information. But as I said, if there's anything, it's a baseline, right? Right? It's a history that helps me know where I was, right? Where I am now, right? It can help me look into the future and can also help me compare to others. I've used that, Dustin, in other classes, and I said, why do we want to benchmark? Why is taking a look at what my P&E, what the PE multiple of the S&P is today? Because I can benchmark it to other periods. I can benchmark it to other indices, right? I can benchmark it to individual stock holdings, right? I can benchmark it to other countries. I can benchmark it to other periods of time or other economic trends. And so it's accumulation, accounting, it's accumulation of information, of financial information that will tell us the history of a company and hopefully will help us become better managers, right? Will allow us to evaluate our business or other businesses. It was started, so, you know, people have always kept records, but accounting, modern day accounting that we know today, the double entry system of accounting that we know today was developed in, does everybody know? Okay, yes? By? Okay, and what he was, okay, so Venetian's very good. That was one of my questions on a quiz before. I used to ask that question. So, Luca? Pacciola or Pacioli, something like that. So, but it ultimately comes from the Venetian merchants. Okay? So in Italy, in the Renaissance, okay? So a lot of things came from Italy in the Renaissance, right? Art, right? Some music, right? And accounting. And ultimately, it was the Venetians were traveling into the Far East, they were trading, and then to keep track of what was going on. You then had, and I won't get into that, we'll talk about it in the capital markets class if you want. In other parts of Italy, we had the evolution of banking at that time as well, and so people were starting to exchange notes and make loans, and there was a need to keep records, keep track of all of this stuff, right? So if I loan one person money, I'm going to remember. But if I loan 50 people money, I start forgetting how much I gave to who, right? And if I loan 1,000 people money, there's no way that I can remember all the people that I loaned money to and who paid me back and who still owes me, right? So I need to have a structure. Now, the double entry system of accounting, which we typically know as what, but debits, right, equal credits, right? So the debits are always where? By the door, right? Debits are on the left, credits are on the right. But it's all based on a very simple algebraic equation. Very simple. And one way to look at that algebraic equation is assets equal liabilities plus owner's equity. Okay? It's very simple. Assets equal liabilities plus owner's equity. Those of you who've been in my classes have seen me I do a balance sheet a lot this way, right? And I just kind of do assets. And I define a capital stack this way a lot of times, right? So my assets are somehow supported by debt, right, or equity, right? If you want to look at it in a simple term, let's just think of our house, right? So I bought a house, it costs $100,000, right? I happen to have $20,000 in the bank that I use as a down payment, that's my equity, right? And I borrowed $80,000 from the bank, right? Pretty simple. Assets equal my liabilities plus my equity.
Where were you 2 weeks ago?
Yeah.
What was going on 2 weeks ago?
Whatever you had to decide.
Oh, but that's, I mean, so that's... Okay, so, now, simple, right? So let's move forward from there. We use reports. We use different reports in the creation or the analysis of our financial information. Three basic reports that we have are a balance sheet, an income statement. A lot of people call income statement a lot of different things, right? What do other people call it?
Profit and loss.
A P&L, a statement of operations. We have a statement of cash flow. Now,
What's the second one? Income one?
income statement. It's an income statement or a statement of profit and loss or statement of operations. P&L. People, P&L. Okay? Now, looked at in simple terms, this is like a picture. This is a snapshot, right? On a particular date. So balance sheets are always as of a particular period, as of a particular date. Income statements are like a movie. It's like a movie. And so they are for a period of time, for the period X, okay? So this tells us where we are in a particular given point in time. This particular statement tells us how we did over a period of time. So, you know, earlier I was showing you, I'll draw it up again, how an income statement looks, right? But it tells us how much we sold, what those sales cost us, the expenses that we had in incurring that sale, and how much money we had left over. The balance sheet is a more simple sort of view that says, okay, at a particular given point in time, I own these assets, and they're supported by this much residual equity that I have, plus this much debt that I have accumulated. Pretty simple, right? I won't spend any time in the statement of cash flow in this class. That's really an accounting thing. Finance people deal with cash flows in different ways. The statement of cash flows in accounting attempts to show a reader what the sources and uses of funds were during a particular period in time. Okay, so like the income statement, it is for a period, okay, for the period from X to Y, okay? And what it tries to explain are the sources and uses of funds, okay? Now, that's a whole other sort of topic unto itself. We won't spend any time with sources and uses statements, okay? So it sort of breaks down into what comes from operations, what are investing activities. It just gets very but it ultimately analyzes changes here, okay? Now, in addition to these three basic statements, there's an additional sort of component to a complete set of financial statements. And that component would be what? Any idea?
Shareholders.
Well, so shareholders' equity is a subsection of the balance sheet. In some companies, they will have a statement of changes in shareholders' equity, which is not required by GAAP, but some companies like to show it as additional information in order to explain movements that they've had. Share issuances, dividends, treasury buybacks, etc. Okay? But not all companies reflect that, and that is a substatement of the balance sheet. So, in addition to the balance sheet, in addition to the income statement, in addition to the statement of changes in financial position or the statement of cash flows, a complete set of financial statements has footnotes. We'll go over that a little bit later today in detail. But the footnotes provide a series of information, including the entity that's information on the entity being reported on, the nature of operations, significant accounting policies, estimates that are used on, depreciation, details on fixed assets, details on revenue recognition, details on income taxes, details on pension funds, etc. Now, why do I make such a big issue out of this? As you will learn over the next several weeks in this class and in other classes, an astute reader of financial statements will find much more information in the footnotes than they will on the face of the financial statements. And because of things that you will learn specifically about real estate, you will see that some of the information that's on the face of the financial statements needs to be supplemented by footnotes, or you're not getting the correct picture. So, as we used to say, what were the words that we used to put on the, I think the verbiage we used at Pricewaterhouse was, on all of the financial statements, we would put a footnote at the bottom of each page that said, the accompanying notes are an integral part of these financial statements. The accompanying notes are an integral part of these financial statements. So, for a complete set of financial statements, okay, you need to have not only the balance sheet, the P&L, the statement of cash flows, and you also need to have footnotes. Now, I'll add a fifth component or a fifth element, and it's you need to have some sort of cover or presentation page, okay? In a large company it's audited, maybe it's the audit opinion from the auditors that explains what period is being reported on and what the opinion or what work was done and what the conclusion was. And internally managed, internally prepared management financial statements, you might just put the period in the company, okay? But you have a cover page on everything. Learn that for your, you can have a cover page. So, one, cover page. You can have a cover page. A cover page could be an audit opinion or a review opinion, some sort of attestation, okay? Could even be a compilation. But you need to tell the reader what these financial statements are. So there needs to be an introduction somewhere, somehow, okay? Cover. And they come in this order: balance sheet, income statement, statement of cash flows, and footnotes. Always in that order. Always in that order. Okay? Now, you might see in some publicly traded companies, they might flip and put the P&L before the balance sheet. But almost always, balance sheet comes first. Okay? Balance sheet comes first. Each one of these statements needs to have a heading. It's very important. And notice how my accounting training, you'll see how my suggested answers to the case study will show, and it's hopefully something that you learn. Every spreadsheet that you ever produce, every document that you ever produce should have a proper heading that tells the reader what it is that they're looking at. So, since we're accountants, we're going to do it the way accountants do it, right? But the proper heading on a financial statement starts with what?
Company name.
Name. Company name? Nope.
Within the sheet. Or
What statement you're looking at. So, it could be a balance sheet, you know, for example, balance sheet. It could be P&L, right? And then what?
Period.
Then a period. Which, if it's a balance sheet, it's how?
Snapshot.
As of. And if it's a P&L or a statement of cash flow?
for the period.
For the period ending or ended, right? Listen, I did a spreadsheet I sent to the athletic director at school the other day, and it started with, Immaculata LaSalle. It had what the statement was, and it had for the year 2014, 2015. Maybe most people wouldn't do it, but when you open up that spreadsheet, and by the way, let me jump to the gun. You know where I left my spreadsheet? What cell did I leave my spreadsheet at?
A1.
A1. Why?
When you open it up, that's where.
When the reader opens it up, he knows what he's looking at. How many of you did that on your submissions? Some of you. How many people left it on like the fourth tab, cell B157? What am I looking at? I don't know. Wow, these are little simple things, right? But you send somebody a spreadsheet, you leave it there, they pop it open, boom. So anyway, this is just like, but this is important, okay? And every statement you ever see from a company is going to have the company name, the statement you're looking at, and the period that it covers. And you laugh, but imagine if it didn't have it. What would people guess? I mean, it's kind of like, imagine you're an accounting professor and you get, 15 or 16 answers to a case study, and not one student labeled an answer. They were just answers everywhere. But there were like 10 questions. It's like nobody, I should say that. One or two people had like, question, answer.
Started to do.
Most people, I just got a cluster of stuff. Like, okay, so what are you answering here? I just got a spreadsheet or I got a Word document. What are you answering? I don't know. Okay.
So we thought you was gonna be able to read it and
Just know.
Everybody just got A's.
right.
Okay, so how does this all happen? It happens on a computer, right? It happens on QuickBooks, right? Does it happen on a computer? Is that how accounting just, somebody? Okay, so I'm old enough. I am old enough. So I'm not the only accountant in my family.
Oh. Explains a lot.
So I come from a long line of accountants. And my brother and his wife are also accountants, and so are my cousins and my uncle, and my cousin, and now my nephew. But anyway,
Should change your last name.
no. So, but when I was in college and I was studying accounting, I would come and work at my dad's CPA firm in the summers, and there were no computers. I remember installing a TRS-80 computer from Radio Shack in my dad's office in like 1979 with like these, like 5.5-inch floppies, and it had like 64K of memory or something like that, Woo. Yeah, woo! But, you remember floppies? This guy's going, what's a floppy? It's not a hairdo, dude. It's not a hairdo.
Here is a hard.
Okay, but we use journals. We had these long, we had these thick books. And we had journals with like 24 column sheets. And so there are 4, let me see if I remember all these things. I'm doing, by the way, your notes would help me because I'm doing this all off the top of my head. It's not here, okay? Let's see if I remember all of them. There are 4 basic journals, okay, in accounting, okay? There's a cash receipts journal, there's a cash disbursements journal, there's a purchases journal, and there's a sales journal. And then we have a sort of a catch-all, which is called the general journal, okay? So I would have recommended for the case study using a general journal, right? Where you make individual journal entries, where debits equal credits. Debits are on the left, credits are on the right. So, for example, somebody, hey, I put $100 into a company. I sold myself $100 worth of stock, and I created a company. And so journal entry number 1 could be debit cash, 100, right? Right? Credit what? Equity? Whatever. Shareholders' equity, capital, whatever, 100. And the journal entry has a description, right? So to record, right? To record the receipt of, share subscription. Something like that, okay? Okay? Now, this entry could also have been recorded in the cash receipts journal, right? So cash receipts journal would look something like this, right? So you would have like this is all ancient history, okay? I'm passing on, this is like an abacus, okay? This is like a slide rule. I'm passing on, nobody does this anymore, okay? But I've had situations where, in fact, I have a situation, I got lucky enough that a friend of mine called me to a meeting one night up here in Sunrise, and there's a whole bunch of Jamaican guys there, and they started a soccer club, and my friend goes, oh, and there's our treasurer right here. So, oh really? So, I haven't bought an accounting system. I just set up an accounting system in Excel, and I basically have created a cash receipts and cash disbursements journal in Excel, and I dump that onto a running trial balance, and that's how I get my financial statements every month for these people. So I could buy QuickBooks, but I'm using this. So anyway, here, so traditionally in a cash receipts journal, your debits would be to cash, right? So this would be debit, this would be a debit here, right? And then you'd have a whole bunch of columns, like 24 columns going out here, right? Okay, and then the last 2 would be like other. And there, you don't have to know this. You don't have to know this, but I'm going to get to the punchline here, okay? So here, so in that particular case, you collected 50, you have a date, right? You have a date. Well, actually, what would you have up here? What would you have up there? The name of the company, cash receipts journal, and for the year, right? So, okay, so let's say, JSM company, right? Cash receipts journal, right? 2015, right? And on January 1, 15, I received a share subscription, right? $50, and here I would say equity, okay? Now, tomorrow, I started selling goods, so I sold $500 worth of goods to somebody, so I would say, okay, sales to Dustin, I sold $500, and here, these would all be credits, okay? And I would say sales, okay? And I would have 500 here, okay? So, what happens is you do this for a month, and at the end of the month, you only make 1 journal entry. You sum what's down here, and you make 1 journal entry, and bring it here. Okay? Now, all your cash receipts, all your cash disbursements, all your sales, all of your purchases, and all of your sales. You can work without those. For most people, most companies, you can actually just do this. Now the computers do this in the background through a database, but this is all that they're doing. So what happens is then you create all these journal entries, and then the sort of next step of all of this is, for every one of the accounts, you basically have, you've seen T accounts, right? You have a summary. And what you do is you post all of these entries into each individual account. Okay? So, you know, you post 50 here, you paid an expense of 10, etc. And then at the end of any particular given period, you take the summation of all of your accounts that have had activity, and you create what's called a trial balance. Does anybody care about any of this? Is this interesting?
Of course. Can I buy one of these books?
Dude, this is not, dude, that's, yeah, go back sophomore year in college, you know, you get take an accounting class. Okay, so you take the sum of all of the journal entries for all of the accounts, and you create one major thing, one trial balance, okay? And there you have all of your accounts. Okay? And this, because debits equal credits, right? These have to equal, right? Okay. Now, from here is where you first create your income statement. Why do you create your income statement first? Why do you create your P&L first? Why do you create your P&L first?
Because you got all your sales.
Takes you up to your balance sheet.
But why do you close out your income statement first?
You gotta know your revenues and
Well, no, because the residual of your income statement becomes part of your equity. If you made money or lost money, it is either going to increase your equity or decrease your equity. So you create an income statement first. You take all the accounts that are pertinent to, so sales, all your cost of sales, right? All of your selling, general, and administrative expenses, interest, you know, taxes, whatever, right? And you get a net income number. Okay? Then you take all the other accounts and create the balance sheet. Right? Assets, liabilities, equity, right? And you put cash, accounts receivable, PP&E, which was what? Big in this, property, plant, and equipment, okay, etc., right? You put all your accounts payable, all your other debt, liabilities, right? And you put all of your equity that you had, plus or minus your net income, and this needs to equal as well. Okay, now you've just created, you've gone from a journal entry to a set of financial statements. Now, you don't even know that every day. You don't need to do this. This is not what we're going to teach in this class, but I wanted to spend 10 or 15 minutes walking through the flow. If you want to know more about this, I can, you know, spend a little bit more time another day going over it. But I really recommend, look, I had, in the first cohort that I had a student, Kelly, who studied finance at UM. Her parents had a small retail business in Palm Beach County. They developed strip centers. She was managing them. Yeah, she wanted to, like, you know, do the program. Great student. What'd she wind up doing? She wound up at a home builder, and she got stuck in the accounting department. She became the director of accounting in the accounting department. They sold the home builder to a national home builder. She's now the director of accounting for the whole East Coast, and she's gone and done a master's in accounting. She didn't know, you know, she didn't know all these details, and she ultimately, because of her position, has had to go back and get a master's. But, you know, listen, it's been a great career path for her. Okay, now, we can prepare financial statements under a variety of different bases. So you say, what's a basis? So we said basis was, well, you paid for something, right? Mm-hmm. In one context. But a basis of accounting is a methodology that you use for preparing financial statements. GAAP, generally accepted accounting principles, GAAP requires, and under GAAP, there can only be one basis of accounting, and that basis of accounting is?
Accrual.
The accrual basis of accounting. And Marisela, what does the accrual basis of accounting require? You learned this at lunch.
I did.
You did. I thought I explained it to you.
When we talk about the documenting the.
Not doc, well, yeah. So the accrual basis of accounting requires you to record income and expenses based upon
When
they are
incurred
earned or incurred. Not when cash is exchanged. Does that make sense? So, the question came before. This is a question I asked you at lunch. I own a candy store. I sell you a pound of candy. You promised to pay me in a month. So, have I made a sale or not?
Yes.
Because? Because you earned. You completed the revenue cycle, right? Okay. But you haven't been paid. Accounts receivable for you. Accounts payable for the guy that bought it. Okay? All right. So, I own a piece of land. I sell it to you for $1 million. You promise to pay me in 3 years. Is that a sale?
You, yes.
No.
Oh, you never.
I don't know. Why don't we stick to, we'll cover that in class number 3, because for real estate, notice how I said before, revenue recognition has different issues in different industries. So, you know, things have changed. The first audit I did out of college was Eastern Airlines. I don't know if any of you remember that. It's an airline that went belly up in 1989. But, oh,
I don't remember.
You don't remember?
I have some work.
You weren't. We have little cross and skull bones. We have stars and there was the CEO of that company is a really cool guy. There was a guy who was an astronaut named Frank Borman. You guys remember Frank Borman? He was the first guy that went to the dark side of the moon.
Oh, and Transformers.
Dude, in Christmas of 1968, he went to the dark side of the moon. And that wasn't a Pink Floyd album. That is a Pink Floyd album, but Frank Borman went to the dark side. I mean, you know, the moon doesn't...
Yeah, I got you.
Okay, right, so he went to the dark side. But anyway, he was the CEO of this company. He would drive in a 68 Camaro convertible. But anyway, the big issue in airlines was how you recognize revenue. At the time, tickets were paper tickets. Now everything's e-tickets, right? But they were paper tickets. So, you know, it was like negotiable instrument, right? So you're an airline, you sold 100,000 airline tickets in a month. And they were only good if you took it to the counter, right? And then it went to a clearinghouse. Because it was negotiable, you could fly on Eastern, but you could fly on National, or you could fly on Delta. And so it all had to go to a clearinghouse, and then basically it kind of got put in buckets, and then the airline that collected would credit, you know, the one that actually earned the fare, the one that actually took the passenger. So how do you recognize revenue at the end of the month in pre-computer days with that? You know, it was a cluster. So it was all done with estimates at the time. You know, now it's all very simple. You know, now they get to see, you know, it's all e-tickets, and you know whether somebody used a ticket or not, you know. But, so revenue recognition, if you're a construction company and you've got a 3-year contract, when do you recognize profits? As you're getting paid?
Yeah. No.
How?
No, as the job progresses,
Under what basis?
well, you just come up with it.
No, you don't. You do it under the percentage of completion method. We'll
Right,
talk.
percentage completion.
Yeah, we'll talk about that in
He
class
pays,
further
he
on.
pays his accountant for that.
He pays, yeah, he doesn't worry about it. I don't know, whatever the guy in pay does.
Yeah, we just do
I'll-
it, we just do it
I'll
on a
add some.
cash basis anyways.
There you go.
Well, and so there is another basis of accounting which a lot of people use, and it is broadly used, curiously enough, in the real estate industry by institutions. Many institutions that are pension plans and life insurance companies are not tax-paying entities. So they don't really care about the accrual base of accounting. I'm not saying it's right or wrong, but a lot of institutions will require you to, especially when you're in partnership with them, to not only send them the accrual statement that you send, but for their own financial reporting, they'll follow a cash basis of accounting. That's not GAAP. They don't care about GAAP. They don't report to anybody. Okay? Now, in addition to that, you've got something called modified cash basis, right? So, in that situation, maybe you recognize income when it's earned, but expenses when they're paid, or hopefully the other way around. Hopefully you're more conservative and you recognize revenue when it's received and expenses when they're incurred. Okay, again, it's not GAAP. It's not GAAP. Some people will report their financial statements on a tax basis of accounting. What's a tax basis of accounting?